During the latest FOMC meeting on 29th October, Jerome Powell stated that, and I quoted from his transcript, at today's meeting, the committee also decided to conclude the reduction of our aggregate securities holding as of 1st December. These developments are what we expected to see as the size of our balance sheets decline and warrant today's decision to cease runoff. When he said cease the balance sheet runoff, it means the Fed's plan to keep its balance sheet stable, basically to stop their balance sheets from shrinking any further under quantitative tightening. But that doesn't mean they are starting quantitative easing again. My name is Con Hao. My work in this channel is to study behavior science and finance, discover correlation between different markets, and uncover potential opportunities. This analysis is based on technical studies and does not constitute financial advice. Please consult your licensed broker before investing. And this is how the Fed balance sheets looks like. With QT 3.5 years ago, and they plan to keep it stable. And how will that looks like? They plan to keep their balance sheet stable. But the question is, how are they going to do that? Let's cover some accounting terms. And in balance sheet, it shows assets and liabilities. The Fed also has its balance sheets during QE, its balance sheets expand, and that's what we're seeing here. And during QT, its balance sheets shrink and assets and liability shrink. So runoff means that the natural decline in Fed's assets when its bonds matured and not replacing it. So therefore, its assets and liabilities has been shrinking the last 3.5 years. To cease the balance sheet runoff simply means not letting these balance sheets decline further or stop QT. Again, it does not mean QE is coming. He wanted to stable these balance sheets by reinvesting those maturing securities until when the time is right, maybe they will start QE later if necessary. Let me quote from his transcript. And he said that we haven't made a decision about the ultimate endpoint, but we all agreed that we want to move more in the direction of a balance sheet that more closely reflect the outstanding treasuries. When the balance sheet is stable, likely the inflation may maintain stable as well. And we can see this relationship in tandem between the Fed's balance sheets, which is the upper pane, and the inflation at the lower pane. And we can see that starting in 2020 with the QE pandemic or the pandemic QE, we saw that the QE expanded, and we in the same time also, it doesn't take many months, just a few months later, the inflation also pick up. And with QT, the balance sheet's strength, so is the inflation right now. So from my observation in QE1, 2, and 3, starting from 2008, I did not see this tandem relationship happening. So we have to understand that creating money and purchase bonds debase the US dollars and cause inflation. And the tandem relationship will take time to kick in. And in 2020, for this pandemic QE, we saw that this relation start to take shapes. So to get a sense of this balance sheet's quantum before QE1, that is in 2008, Fed balance sheet was around 900 billion US dollars. And in 2008 with QE1, and we saw that the balance sheet jumped to around above 2 trillion US dollars. And then with the pandemic QE, after that, it jumped all the way to close to about 9 trillion US dollars. So what is my view on inflation and interest rate or yield with this policy that is to keep the Fed's balance sheet stable as of now? Inflation or yields should remain to stay at this elevated area in a tight range. And this is the cash yield. Let me just show you an example of a 10-year yield. And so interest rate and yield, they also move in tandem together. They influence each other. So what we're seeing here is a very long-term interest rate or yield chart over the last 40, 50 years. And we could see that with the pandemic QE, inflation started to pick up. So the interest rate and the yield as well. And with this policy of keeping the balance sheet stable, and there we could also see that highly likely that the yield or interest rate will maintain at this very stable level for a longer period of time. And that's what we're seeing here. And this is a weekly chart. So I reckon that the interest rate or yield will continue to trade in a very tight range. And that's what I'm saying here. Until a point in time, and that's what the Fed say, they may deploy QE or maybe QT again, and we will get to know as time passes. And if the balance sheet start to move up, you could see that there's a tandem between the Fed's balance sheet and the inflation and the interest rate and the yield. And this is what we're seeing, the yield. And this may happen if QE start to kick in again, and we can see all the other assets will start to shift, including this 10 years yield. I will continue to monitor the Fed's balance sheets. When it starts moving higher, it means that the Fed may have changed its policy from keeping it stable to expanding it. That will also mean that QE is back. And once that happens, it should start affecting every else or every other assets again. So see my description. I will include the latest FOMC transcript pertaining to the Fed's balance sheet. Feel free to leave any comments below. I'd love to exchange ideas with you on what is about to come. Really happy that I stayed through this tutorial. You have many great trading weeks ahead.